Who wants to take it first? Nobody.
I'll go first.
Okay.
I don't remember what the 4 items were,
Okay,
but no, that's all right. I think we definitely saw a significant increase in capital spending. I mean, the bonus depreciation was a real incentive for people. I don't know whether we were just pulling forward capital expenditures a year or maybe 2 years, but that certainly created some stimulus. Okay. We are definitely seeing increases in wages, although my own reaction on the increase there is really because the labor force is remarkably tight right now. So I think we're seeing with our clients, they're really having trouble finding skilled people. Mm-hmm. So whether that's a result of the Tax Cuts and Jobs Act or not, that's a really good question, but we're seeing some real pressure in that regard.
Good. A couple of you other guys, can we now fit all the tax returns on a postcard? Are we able to do that, guys?
How big a postcard?
About the size of this wall, I think.
Yeah, you can do it if it's the size of the wall.
Yeah, so it certainly hasn't been simplified, that's for sure, and it's going to be a long time before we can fit it on a postcard, I'm afraid. And what do you think that the tax cut did, to stimulate business, small business and big business? Do you think it did help stimulate the economy and get business going again? What's your feelings about that?
I think that maybe the verdict's still out on that a little bit. I think there were some significant tax cuts that passed through to various business owners. And the idea is that they'll take those savings and replow that back into the economy and jobs and new business. And I think that's what we're going to kind of wait to see. I think there were some significant cuts for certain people. If you had, fairly good income, you got some sizable tax savings this year. Whether that's plowed back into the economy, I think, is what we're going to wind up waiting to see. And the one thing that wasn't talked much about is that if you had businesses losing money, there was no benefit there. So, it helps the business that are making money, and we'll see what it does in the long term.
I think what Dave's referring to is they eliminated the loss carryback. Is that what you're referring to? So that you no longer can carry back losses into previous years and get tax refunds. So that was part of the trade-offs that went with some of the tax law changes. But I think I'd like to talk a little bit about the fact that, and maybe all of you had some experience with this, is maybe you were expecting a bigger tax refund at the end of the year and that didn't happen, or maybe some of your customers were expecting that big tax refund so they could buy that new vehicle from you, and that didn't happen. Why didn't it happen?
Yeah,
Why didn't it happen? Who wants to take that one?
I would say, for a lot of the customers, one thing that I have noticed is people that may have just wages, a lot of the people may have gotten a tax refund, but it's embedded in their wages, so their withholdings went lower, so they had higher net pay, but at the end of the day, they may even have a lower tax answer, but because their federal withholding was adjusted the other way, they ended up having less of a refund or even owing, is what I've seen.
Anybody else want to?
Yeah, I've seen the same thing, and I think it's causing a lot of confusion for folks because they always measured success in taxes based on the amount of refund without ever considering how much was being withheld. So if you want a really huge refund, put 0 withholding exemptions and let them withhold money, and you get it at the end of the year. A lot of people hadn't quite figured that out. So the withholding tables changed early in the year, and so the federal government expected refunds would be large, and so to accelerate the payment of the refunds, they adjusted the withholding table. But at the end of the day, if you're dealing with your customers who say, no, the whole measure is not my tax liability, but the measure is my refund, they were pretty unhappy with the tax law change.
So I'll say anecdotally as well, talking to our buy here, pay here clients, tax season is a big big deal for them.
Yeah.
And you know, virtually all of the folks that I've spoken to said the year's going fine this year, but tax season was disappointing. And you know, just this comment, which is withholdings are down, rates are down, withholding is down, refunds weren't as large as anticipated, and it dried up a source of capital for borrowers, you know, to fund their vehicle acquisition. So it's you know, it's definitely had some impact. We'll say, sadly, for our buy here, pay here clients, a little bit of a negative impact.
Well, I think another problem is that, you know, people didn't know to adjust their withholding. They were using the old forms and they just kept the same withholding, and they didn't take advantage of the changes that were embedded. And I understand now that they've just come out with a new form for calculating withholding for this year. Can anybody talk about that one? So maybe we won't make the same mistake again. True? No. Okay. Well, yeah, I think there is a new withholding.
You're correct. You're correct. There, I believe, a draft has been released. There is a new form, but I'm not certain yet it's going to fix the problem or not.
I think it's safe to say that we haven't weeded through it. It's a new form that's in draft form, and it's extremely complex.
Yeah.
And I think, you know, they're saying it's going to take an accountant to help people fill out their W-4 to change their withholding at this rate.
We're all hoping that, aren't we?
Yeah.
But I think that the message here is not only your customers, but you need to be looking at your withholding this year and maybe making any adjustments so you don't repeat, you know, the same problem that we saw in 2018. In the tax law changes that were made in 17, because they were made so late in the game, do you think it created a complexity for you guys in preparing tax returns this year? Did it hurt your clients' ability to plan and get a better tax answer? Who wants to take that one? What effect did it have on filing returns, extensions, and planning?
So for our firm, the new tax law created quite a bit of complexity, and as a result, we had, you know, more extensions than normal. And I would say that the complexity, in essence, I think for a lot of our clients, there would be some things that are negative that would hurt their tax answer, and there will be some things that are positive that would help their tax answer. When they're all netted together, I would say overall, generally speaking, they got a better tax answer than the prior year. It would come out ahead. But there are quite a few complexities that could really impact that person to person.
Okay, good.
Now, one thing our firm did, and remember, we're a large national firm, so our practice is many, many different industries, and some of what I'm going to say in this comment may not necessarily apply to this group, but in some elements, the tax law is still very vague. Proposed regulations may or may not be out. Very few final regulations are out, and there's a lot of questions. And so our firm did a lot of publishing, and we recommended across the board that everyone extend their return, even if you intended to file or even if you could file by the due date. And the reason is, if you've extended, you may get a upside benefit if and when the final regulations come out. If there's a beneficial regulation and you extended, you get to file what's called a superseded return, and it can be a little bit easier to do than filing an amended return, which is the way you would go if you had not filed an extension and just filed your return.
Yeah. Unfortunately, it's not an extension of time to pay. It's just an extension of time to file. So the problem is figuring out where you're going to be so you've paid in tax adequate so you don't run into a penalty. But clearly, the rules keep changing all the time. We keep learning new things. So we're just trying to help you apply those rules. Anybody else want to comment on the effect of these tax law changes?
You know, from a planning standpoint, I know I'm certain all of these guys agree. The real challenge, and you know, the reason why you guys recommended extending returns is that they're still coming out with regulations, guidance on the law, and interpretation of the law. So you have a lot of things that are gray. You have a lot of things that need to be interpreted in the absence of guidance. we'll interpret things in favor of our clients, and yet we'll say, unfortunately, without the guidance that entails taking some risk.
Yeah.
And so it has made planning throughout 2018 very difficult. I think for us, you wind up seeing things as you run through the year-end compliance process, preparing returns, and you're like, wow, that's the way the law reads. You try and anticipate what it's going to be, but there are always some unintended consequences.
Sure.
After year end. So it's been a remarkably difficult year, and I think it's great advice that you guys gave your clients to extend just to give you the flexibility to wait for more guidance and be able to respond.
I think that's right. And go ahead, Scott.
I realize some of what we're talking about is kind of abstract. Let me see if I can give you an example at the risk of too much complexity that is directly related to probably everybody in this room if you have any kind of debt financing. So the new law has a limitation on your interest expense, and it's the sum of 3 different items, one of which is debt or interest paid to do floor plan financing. And so it says if you have floor plan financing, that goes into your interest expense limitation, which in general is really pretty good. But it says if you include it in the computation, then you don't get bonus depreciation. So there's a cost. So you look at the proposed regulations, and they make it sound like that's not elective. You read the Joint Committee report, which is basically the people that helped Congress write the law, and they have examples showing that it is elective. So is it elective? Is it not elective? Does it help you? Does it not help you? We don't know. And so these are the kinds of things that we're facing with our clients and the kind of complexity that's out there. So when you hear your personal accountant whine, you'll understand a little bit more of the pain that they're kind of going through, and hopefully sheltering you from some of that pain by helping you through decision-making process with these complicated rules.
Dave?
I think overall I'd agree with what everybody said here. I think planning was more important, and I think that we felt like we got out in front of a lot of the planning, but there were a lot of things in the tax returns that pop up that you may not have seen. And I think what's very interesting with the law is that this isn't a one-time thing, that you did it when the law changed, and from here on you can write on automatic. You're going to have to look basically at your facts and circumstances each year with what the law is and do planning each year for this. And like I say, there are some carrots out there, if you do it right, where you can really have some significant savings. But it is going to be an ongoing thing while this law is in place. You're going to be looking at, your interest and what your business income is and what related entities you've got each year through at least the period this law is set to go through, which is 2025. So it did make our job interesting. We had forms that were wrong. Our software providers we use, they had information wrong. I know we went with a number of returns. I don't think we could even file a return until about March 7th.
The forms weren't even available. Yeah.
Right.
And then there was a security problem with one of the largest providers of software, and that pretty much shut down tax return prep for around 10 days or so.
Yeah. I just say this to you, that if you wait to the last minute to give your CPA or your tax advisor your tax information and say, here, what's the answer, you're asking for the worst answer possible. You need to be working with your tax advisor or your CPA on a year-round basis now. I think you need to start early. You need to have him help you develop a good tax answer. There's never been a time where it's more important to get professional advice because of the complexity of what's going on out there. And look, we're learning the same way you are, but we'll help you interpret the rules because that's what we do. So I just encourage you to work closely with your tax advisor all year round. Now, part of the Tax Act was a change and a reduction in the tax rates. Who would like to talk a little bit about what those changes were, and did they in fact benefit the taxpayers, the dealers that you did with the rate reductions? Who wants to take that one?
We definitely, profitable dealers were vastly rewarded under the new tax law. I mean, the say 199, the pass-through deduction was a massive rate reduction for again for those profitable dealers. So in that regard, the Tax Cut and Jobs Act definitely delivered very significant tax savings, and say. I think the vast majority of our clients are pass-through entities. Very few C Corp clients. So, the rate reduction was substantial and really benefited again those profitable dealers.
Yeah, I think one thing we got to talk on. Maybe you're a C corporation, or maybe you're an S corporation, and because of the tax rate changes, and I'd like to talk about that. Well, is it better to be a C than an S, or should you make a change? Can somebody talk about what that issue is?
They lowered the tax rate for the C corporations down to 21%, and then of course with some new provisions in the new tax law with qualified business income QBI, they've effectively lowered the rate for personal returns as well. I've had a lot of questions about should I convert my S to a C, and I think it does depend on the unique situation, but generally speaking, I would say the S corporation for most of my clients remains for a number of reasons. One of them is a lot of my clients might have, for example, a loss on a dealership, but they might have a profit on a related finance company. And if there are S corporations, you get to net that loss, assuming you have basis in the dealership, you get to net that loss with the profit that you get from your related finance company, so that you can net the two together on your return. If you were to convert them both to C corporations, the loss in the dealership might be stuck at that level and can't be netted, but the C corporation would still have to pay the profit. And so, generally speaking, I would say it's not necessarily the right choice for everyone. There are some things you can do, like overhead, to help with that calculation, but for the most part, and it does depend on every unique situation, but generally I still see the S corporations remain out.
Go ahead, David. Oh, I was going to say, I think we generally echo what he's saying there. I would say it's like everything with this law, that you've really got to look at it. We did have some situations where we took people to C corporations, and the idea generally behind that was that with the lower tax rates, and if you have a fixed amount of capital that has to stay in your business and you're not going to be distributing it for a number of years, then you could find a situation where you drop your tax rate from, like on a federal level, from 29.6% to a 21% rate, and it could make sense. So we did have a few, but in general, I'd say it's kind of what we said, that generally people were better as S corps, but it is something that you got to look at on a each specific situation. And this law is I mean, and I don't, for people that aren't in this is the biggest law change in 30 years. I mean, you got guys like me that have been doing this for 30 years, and it's like starting over, trying to figure out what the new rules are. And so it does have a lot of, places you've got to look and try and look at every situation.
I think this area was the biggest shock for me. I thought we were going to be converting companies left and right. It just seems like, man, you drop your tax rate to 21%, that's got to be sort of like nirvana. But we did a lot of projection work where we looked at things for many, many years. And one of the things that jumped off the page was the compensation to the owners. And we see with S corporations often that the owner's taking a salary and they're also taking a distribution. So echoing what Dave said, if you're in a scenario where your distributions are significant, a significant portion of the profits, well, if you're in a C corporation, that becomes a dividend. If you're in an S corporation, it comes out differently. So what we were finding is your break-even point was 13 to 16 years. So if you were going to if you're going to convert and hold for that period of time, maybe it made sense. But 16 years from now, do you think the corporate tax rate's going to be 21%? So on those circumstances in which it looked like there was a lot of benefit, 10 plus years out, a lot of the owners were hesitant to make the change, thinking, I don't know that the rate's going to stay at the historic low for that long.
Yeah, I think, the tendency is to look at the rate differential on paper, the higher rate for the 21%, and think, well, it's a no-brainer, I need to switch. As you can tell by talking with these guys, there's a lot to it. You need professional advice and assistance in being able to evaluate the impact, and you got to think about the long term as well as the short term as well. So if you're still considering possibility of making a change of tax entities, get some professional assistance, do an evaluation of it, look at the long term, and make sure that you're making the right decision. I want to open it up to any questions that you may have. Anyone have a question that they want to get answered? I've still got some more here. Yes, sir. Go ahead.
So I believe on in the 2018, if you do it a capital expense, so for instance, buying a lot, $30,000 lot truck, I believe now you can expense 100% or whatever percentage you want, and then you either, if it's 100%, you're done. If you do 50%, you can do 50% in 2018 tax return, 50% 19. Is that correct or incorrect?
Well, I'll let these guys answer that question, but I want to clarify something. Again, if you've got a vehicle that you're selling, you're going to resell. Yeah, I mean, let's differentiate between a vehicle that you're trying to sell to a customer versus a company-owned vehicle. You want to take that one in terms of the depreciation rule change?
I'll go and jump in there. I think basically what you said isn't completely accurate. They did change. If you're talking about a company vehicle, you kick a lot of different laws into that.
Right.
There's some luxury auto limits and some things that might scale back the benefit.
Right.
But in general, with most equipment, the bonus depreciation does allow you to write it off in the first year. But you said then, if you don't want to take that, you can kind of take whatever percentage you want and do that, and that's not true.
That's
right.
You
basically take bonus depreciation or Section 179, and if you don't take that, then you've got a regular depreciation schedule you've got to follow so that it'll be depreciated over 3, 5, 7 years. And so you can't just say, well, I want to take 50 this year and 50 next. It's either you take 100% or you follow the regular depreciation schedules. That makes sense?
One of the things you got to look at is, do you have debt? If you have debt and you're using floor plan interest in your debt limitation, it says thou shalt not take bonus. So I don't know the circumstance of what you've got.
Maybe. No. Your point earlier.
My point earlier depends on, how, which decision you want to make. Do you want to follow let's have fun, everybody's going to know what I'm talking about. You're going to follow the proposed reg or the blue book? Let's go get a PhD in tax theory. So, it is a difficult scenario for your advisor to help you with that decision.
Somebody came to me during the conference and said, well, hey, this is great. We've got a vehicle that we're going to sell to a customer, but we got it at year end, so we're just going to take the bonus depreciation on it and then sell. I said, no, you can't do that. You've got to differentiate between a vehicle that's being held for resale, that's called inventory, and a vehicle that you're using at the company level. So don't get confused. And what Scott said and Dave said is important. Make sure you understand what you're giving up when you take that bonus depreciation.
Yeah, to expand what you're saying, we've had a lot of questions. The rules change for what's called uniform capitalization, and it's a complex set of rules for inventory. But if your revenue is below $25 million, the unicap rules have gone away. We've gotten questions that says, so that means I get to expense my inventory?
Yeah.
No. You still capitalize the inventory, you just don't have this incremental calculation that drove your CPA nuts. You don't have to do that if you're under the income threshold, but you don't get to expense your inventory.
Yeah, I think, if you've got inventory, there is an ability to write it down at the end of the year to fair market value if you've got vehicles that are in your inventory at cost that exceeds their fair market value. And generally, we saw, when I was practicing, I'm not anymore, but that we saw a write-down usually occurred at the end of the year. Primarily, if you're buy your pair, you're putting reconditioning cost in it, and that doesn't necessarily increase the fair value of it in the marketplace, so you can generally get a write-down there. Anybody want to comment on inventory? Any thoughts on that?
The only thing I might throw out, there's been some confusion, is with the new law, they basically provided that you could, if you had under 25 million of gross receipts, which will be quite a few people in this room, that you could go to the cash method of accounting. And there were some people that thought that meant two things that basically we feel like neither is right at this point, is that you could, then not have to keep track of inventory and just expense a car when you purchased it, even if you hadn't sold it. And that is not correct. You don't have to really, you can still be on the cash method, but you can't just write off your inventory. You can't say, well, I'm close to the end of the year, I'm going to buy 10 cars and get rid of all my income. It doesn't work that way. So you still have to basically be under the same rules of, not doing anything with inventory until you sell the unit. And then secondly, there were some people, thinking that you could take your note receivable and just, record payments as you collect them and didn't have to do the note receivable. And that's not correct also. You've got, you still are left under the old regime or trying to pick up a fair market value adjustment.
And I'm doing a whole session on that tomorrow afternoon about the same time, where people who think they don't need a related finance company anymore because they're going to use the cash method accounting. I'm going to explain all that, what the rules are. So if you're confused about whether you use the cash method of accounting, I'll give you a lot of things to think about. And what Dave's just said is generally correct, but there's a few more things we'll add to that. Anybody else like to comment on that? Anything? Okay, very good. Again, any other questions out here before I keep going? All right, let's talk about...
Oh, you got one over there.
Right down here. Okay, yes, sir. Yes, sir. Let me see if I understand the question. Is your question, is having reinsurance a good thing if you got a mature portfolio and plenty of capital, or is your question having multiple reinsurance companies?
Well, my question now is that, over the last 15 years, we've funneled all the profits to reinsurance.
Yeah. Yeah. Okay. Right. Okay, so you want to start accessing the capital that's tied up in your reinsurance company? Is that your question? I see. Okay, so is there a benefit to having a reinsurance company? Who wants to take that?
So it is a really interesting question, and I think we've done some pretty extensive analysis on it. It's a lot closer now. It's a lot tougher question. Under the old law, your reinsurance company, I presume that it was a 831B company, so you were not paying tax on your underwriting income. You had a huge delta, a huge spread between the dividend tax rate when you took money out of your reinsurance company versus the ordinary income tax rate that you were paying in your dealership. And so when you had such a big spread, it was clearly a no-brainer, right? You had 20% spread. Well, now when you're looking at between the capital gains rate along with the Affordable Care Act tax, the spread's not nearly as much. And then you throw on top of that the fees that go along with having a reinsurance company, because nobody works for free. You can look at those fees really like being a tax. You're just not paying them to the federal government. You're paying them to a vendor or a provider. So we have certainly seen clients that have said there's still a spread. I mean, I at least on most of the deals that I've seen, there is still a spread, and that's a permanent tax savings item. And so, there's, we'll say generally, still a benefit. It's not nearly as material as it was before. You also get the potential for deferral, right? Postponing that tax every year you accumulate. You have the potential to defer the payment of that tax. So that's something that, I think probably everybody on this panel would say it's one of the things we look at every year, trying to defer the payment of tax as long as possible. But it's much more challenging. It's a lot closer because the spreads are smaller now. Who knows what the future holds? Rates are rates. Well, I don't know. I've predicted that rates are likely to go up because we've been running deficits for so long. But if rates go back up, you got the spread again, and it's in that case, manna from heaven.
Okay. Yes, sir.
On reinsurance,
Somebody else want to add?
I'm a fan of reinsurance, but it scares me. It's one of the things that keeps me up at night. I kid you not. What are you investing in your reinsurance company? Is all the money coming back to the producer? If so, it looks like a circular flow of cash, and I think you will have an interesting audit discussion if it's examined. The other one is what are you insuring? And if it is something that comes to be as a clip, then it is self-insurance, and are you filing your 8886s? And what are those costing you to do? And if you've missed that, check with your advisor to take a look at it. So there's a lot of built-in complexity with reinsurance companies that I see just gets missed. So if you've looked at that, great.
Yeah, so I think a message is, does the risk justify the reward with the gap shrinking? And I think that's something you got to look at. You got to look at currently, don't you think?
Yeah, I think I would just add, I agree with Kevin. We did quite a bit of analysis and found that we do generally see that there's a benefit there. It has probably been reduced by about half from what it was with the higher rates. And the longer the reinsurance company runs before you pay that level of tax, the more beneficial it is because you've got a bigger deferral. And one other thing I'd say with the gentleman asked is, I hate when somebody says we're taking all the profits and sticking them in our reinsurance company, because I hope the IRS doesn't hear, because I basically say what we're doing is we're generating underwriting profits with an insurance product.
So you share my nightmare.
Yeah. When somebody says that, it makes me a little nervous. So I understand the comment, but
Any IRS agents in the room, please raise your hand.
Yeah.
All right, very good. Anything else that anyone wants to add before we move on to this gentleman's question? Okay. Yes, sir. Did you have a question?
I have a question. A dealership that I know about has had an issue with the IRS regarding the related finance company.
Okay.
And I'm getting this from the owner, so I really
Sure.
don't know what the details are. But the issue is that the IRS is claiming that because their corporation is an S corp, they're disallowing the related finance company rather than an S corp rather than a C corp. We don't know what the issue would be. What's the difference between an S corp and a C corp when it relates to the related finance company?
What is the related finance company? Is that a S corp or a partnership or a C corp?
It's a LLC.
Do you know if they file a partnership return or an S corporate return? The reason I ask is because you want your dealership and or related finance company to be S corporation or C corporation. It doesn't matter.
Correct.
Those are fine. You should get your loss on note sale. One issue could be if either entity is a partnership, then I think you've got an issue. It's not that it's an LLC, is it filing as a partnership? 'Cause I believe the partnerships will not qualify.
An LLC can be taxed as a C corporation, an S corporation, or partnership. And so, that's what Stephen's saying. You got to drill under the covers a little bit to say. Now, if each of the two entities are corporations, then he should be fine. But I've not met an IRS agent that understood these things. And I haven't met an IRS agent that had read their own audit guide. And so I am not surprised at all that early stages of audits are very difficult. I don't know if you guys have had the same agents or,
well, yeah, the technical answer, 100% clearly the two entities have to be corporations, okay? That's a requirement of the regulations in order to take advantage of this. Actually, now I'll say, this is actually the reason that anybody that is in the buy here, pay here industry needs to use somebody that has experience in buy here, pay here. Definitely over the years, seen buy here, pay here operations that were set up, kind of as Steve was saying, partnership corp doesn't work. Could have easily worked from day one, just as everybody here hopefully is properly structured. Could have worked just great. I've had some agents dig in. You know, it's in the audit guide. If they follow it, you know, they lay it out pretty clearly. You know, I'll say if your friend is in the partnership corp situation, I think they're going to be in a world of hurt. They're going to be in settlement mode. You know, hopefully. So.
Just out of curiosity, I'm assuming it's a related finance company, right? If it's a third party, it might be okay no matter what. If it's related, then the partnership becomes an issue. But you said that the reason the IRS agent didn't allow it was because the dealership was an S corporation. That would not be valid. The S corporation would be fine.
Yeah. Well, and let me explain why. I was a pioneer of the strategy, so I can tell you where it's coming from. The exception to allow you to use a related finance company is at 267F-1F, and that's an exemption under the related party rules, but it only addresses corporations, and so that's why you have to be either a S or a C corporation to fit under that exemption. So that's the answer. That's the answer. So what these guys said is exactly right.
So the related finance company has to be a corporation as well?
It has to be taxed as a corporation. So what Steve said is that if you can have an LLC, but you can't tax it as a partnership, you got to tax it as a corporation. It's just an election you make. It's just an election when you establish the return, or when you file the first return.
You can have any combination. So when we're talking about corporation in this context, it's taxed as a corporation, a C corporation, or taxed as an S corporation. So you can have an S and an S, a C and an S, a C and a C. That's all the alphabets we've got. But if it's anything to a partnership, it's fatal.
That's exactly right. Yes, sir.
So
no, you can be an LLC. It's just you have to be taxed as an S corporation or a C corporation. But an LLC can make an election to be taxed as a partnership or be taxed as a C corporation or an S corporation.
Correct.
So all we're saying is the LLC must have made the election to be taxed as a C or an S corporation. They should file a Form 1120S or an 1120. If it says 1065, that form number could be an issue.
Well, you come to the session tomorrow on related finance companies. I'll cover it, and if you need me to talk to them, I'll be glad to talk to them, and any of these guys can talk to them as well.
If your accountant hadn't caught that, I'm sorry, but you might want to talk to a different accountant.
I think it's possible in this case. I don't know.
You look at the form number. If it says 1120S or 1120, you're fine. Sleep easy. You can make a real quick call and say, what form is that on? And, you know, then you won't be up all night wondering.
Yeah. But make sure you understand when you go back what you need to look at, because it is important, and it can come back to haunt you if you haven't made the proper elections. Correct. Correct. Other questions? Other questions? Okay. Okay, thank you. Yes, sir. Okay, limitation on the pass-through deduction. Who wants to take that?
What did you say?
He asked, is the pass-through deduction limited to the amount of wages, W-2 wages, that were paid?
It depends. It depends on what your AGI is. If your AGI is under, I believe it's 350,000, you don't have to worry about that. If it's over 350,000, then there are limitations based on fixed assets and payroll. Right.
If it's over that, he's asking if it's over that, then the wage limitation comes into play, right?
Right. You look at two limitations. You want to run them both, but yeah.
So the worst case scenario is it's whatever the W-2s are times 50% would limit how much of the deduction you can get. That would be if there's enough income.
Okay. Good. That answer your question, sir? Understand? No? You're shaking your head no? Okay. Very good. Question in the back. Yes, ma'am. Okay, so your question is, if you don't have an accountant that's real familiar with the tax elections and the tax practices in the automotive industry, what should you ask them about the change in the tax laws that we're talking about here? Who wants to take that one?
I guess I would start off. I mean, the big benefit from the tax law had to do with the 20% tax rate reduction for flow-through entities, which is S-corps or partnerships, or the 21% rate deduction or 21% rate for C corporations. So I think that's the big one that you'd start with is, am I maximizing that? Is there any planning I need to do? There's some options to combine entities for that purpose and, get the 20% benefit with regard to some real estate situations and some other things like that. So I think that would clearly be kind of the big item to look at because it's where the big dollar savings would be.
Okay, great. We're just about at 4 o'clock, and I want to give these guys each a chance to talk about one takeaway that you can suggest from what you learned in the 2018 tax filing season that you can suggest that these people consider as we go forward in 19 that's going to help them. Give us one takeaway. Who wants to start first? Not everybody at once.
I'll jump. I mean, I think one thing is that as we talked, that there's a lot more planning than there's ever been. And I think just working in this industry a lot of times, there's a number of people where your accounting records may not be, up to date, or you come up with them at year end. And I think it's more important than ever to basically get good accounting records so you can do the planning.
Good. Very good. Steve?
I concur. I was going to say I recommend that everyone talk to their CPA about maybe looking at a tax projection because there's so many unique things and unique considerations that don't necessarily apply to everyone but might apply specifically to someone. For example, if you're in real estate, maybe discuss the possibility of doing a cost segregation study. I think a projection with your CPA would be something to take away.
Very good.
Plan early, right? I mean, that's really what it comes down to. So all of these, there's a lot of dials to twist in the new tax law, and twisting one dial to the left doesn't mean you're going to have a corresponding twist of one dial to the right. And so as you look at aggregation rules, interest limitations, bonus depreciation as a result of floor plan interest, there's just a lot of things for all of you to plan for, and it takes time. So don't start in December. Have that dialogue. Get on it as early as you can.
Great. Scott, did you have a comment you want to make?
Well, as we've overwhelmed you with federal taxes, let's not forget states and your sales and use taxes. And there was an excellent, though not well-attended, presentation yesterday about estate planning. So I won't ask you who's got your wills done, but maybe by this time next year, having just lost my mother and seeing how smooth we finished closing an estate because we had it set up was with a trust, made everything that was said in yesterday's presentation very good. If you were hit by a car tomorrow, let's hope that doesn't happen, who's running your business? Is there a fight for control, or do you have it covered? So off the federal thing, but think about your planning and your business in a big picture manner.
The message I'll leave you with is that you can see there's a lot to these tax law changes. It's gotten more complex than ever before. You need to get professional advice. You need to start earlier. You need to plan because good tax answers don't happen. They're made. So the reality is we encourage all of you to, from this session, realize that there's a lot to it and get the professional advice you need to get the maximum tax deductions and benefits that you can. I'd like you to give these guys a great hand. They did a great job. Thank you.